Hello, everybody, and welcome to the Daily Dose. Today is Wednesday, January 25th, and we had another interesting day on the stock market today as earnings continue to start to roll in. Tesla reported today. They beat on profits. I didn't get a chance to read through all of it, but I think that they were forecasting maybe some slowdowns in production in the coming months. But I did see that they beat on the bottom line profits. So maybe some companies surprising Wall Street with beating on earnings. And we did kind of see in the beginning of the day today that selling pressure. And we actually came back down, tested this 200-day moving average and our trend line again. The trend line coming through here. And we bounced off of it again. So we've continued to put pressure on these supports now. They were resistances, but now they're kind of acting like a support. We've put pressure on them. We've respected them. We've bought back up both days. But I think if you're a bull now in this market, you want to start to see some continued momentum to the upside and really see us push off of these levels. That would be a really bullish indicator. And if you're a bear, obviously you want to break back down below the 200-day moving average and our trend line that's been on the chart since this bear market started. But who knows? Maybe the bear market is now over. So, I mean, you can see these candles down here. They stick out as breaking out of this trend, out of this channel, really. And even I was one of the people that really was expecting us to go lower. I didn't think that we'd break out truly this early. Typically during a recession, or I guess a better comparison would be a rate hike cycle, you don't see the market bottom typically until about 2 months after the Fed begins to cut rates. And if we did already see the bottom in this market, that means we saw it back in, what was it, October? So that would be really interesting, because that would be, I mean, that could possibly be like 4, 5, 6 months before the Fed starts cutting, even longer than that. It could be over a year until the Fed starts cutting from last October, if they truly do hold rates at the whatever rate they decide to go up to. If they do stand true by the statements made in the beginning of this year that they're not going to pivot at all during 2023, then that would be an interesting place for a bottom. And you know, who knows, we may not have bottomed yet, but you know, every day that passes that we're staying above this 200-day moving average and this trend line is just more of an indicator that we're broken out of this trend. So I'm not saying that we've definitely broken out, bottomed, and that we're only heading higher from here, but I can't ignore what's happening on the charts at the same time. So yeah, looking a little bit bullish on the stock market. Again, cautiously optimistic. This could turn around. We still have to hear from the Fed at Jackson Hole in a few weeks, so there's still a lot of things going on. But, you know, you can't ignore what's right in front of you. So let's take a look at Bitcoin, kind of doing the same thing. Obviously, Bitcoin was on a way stronger run than the stock market, as it's a much more volatile asset class than stocks, but we bulled higher on Bitcoin. We're kind of holding now around the 22,000, 23,000 level. And let's actually go back and see if that makes sense for us to be holding there. So let's take a look at this green dashed line. And I mean, I lost it. And I mean, yeah, I guess it kind of makes sense for us to close there. You know, we have a lot of structure here. Maybe it's finding resistance right here. But I think the next major level is definitely going to be up here between the 28 and 30,000. So if we do see a continuation of that uptrend, I would expect to get there at some point. And then again, this resistance right here around the 20K, I think 20K now is going to be, again, a really big support level if we do head back down. I think 20K, I mean, you could compare that to like the 4,000 on the S&P 500. Yeah, there's some structural support there, but it's also just a huge psychological number, and that's why you kind of get consolidation around those zones in the first place. So I would kind of compare that to an S&P 500 4,000, just in your mind, kind of. So, you know, both of these markets are looking bullish at the moment from a technical standpoint. They both look like they're breaking out of downtrends. And if that is the case, we could definitely be going higher. But I don't just want to sit here and feed you like bullish, 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 whatever. You got to look at both sides. So obviously the bearish case is that we still could see some misses on earnings. And even if we do see some earnings that are maybe surprising a little bit on the beat side, I think a lot of what the Fed's doing with the rate hikes is not truly felt yet. We're just now starting to feel the effects of that, these rate hikes. And they did raise them so aggressively, and typically you don't feel that till later. It's kind of like a lagging. They're lagging indicators when you see stats about the job market or about the economy as a whole. They're usually lagging indicators to what's going on. So I do think the next 1 to 2 quarters, maybe 3 quarters throughout the rest of 2023 will truly show the effects of all this tightening that we've had. And so even if we do get through this earnings season mostly unscathed, I think if you want to look like 3 to 5 months down the road, there could definitely still be some problems with earnings that could drive this market lower. And, the Fed could stay super hawkish. Who knows how high we'll go? Maybe we'll go over 5% for the federal funds rate. And I do believe that would have to drive the market lower. So it's not all, good times in the market. You still have to look at both sides. But the technicals, the price action, what we're seeing, it's looking a little bit bullish. So I'll leave it here for the day. I appreciate anyone who is listening or watching this episode. Please subscribe on YouTube and follow wherever you listen to podcasts. And I will see you again tomorrow.